Hey everyone, welcome back to another episode of the Meet Kevin Show. Today, we are bringing back Ross Gerber to help us understand what the heck is going on in the market. Why are small caps the hedge of the world right now, going into the toilet? Why is everyone going into the megas? What's going to happen in 2022 when we get potentially 3 rate increases? Is the Fed going to lose it? Are we going to pull off another end of 2018 where the market ends up falling? I don't know, but I think Ross has some insight. So welcome aboard, Ross. What do you got?
Hey, how's it going, Kevin? Good to see you again.
Great. Welcome back.
I forgot my sweater. I'm sorry, but I'm
Oh,
Jewish, so
no
we
worries. We got 2
it's
days
what
left. So you got 2
that's
days. You just have
true.
to
But
post a Twitter picture with your sweater. And of course, remember, this is Ross Gerber from Gerber Kawasaki ETF and fund, linked in the description down below. Not sponsored. All right, Ross.
not sponsored. And also, I am a financial advisor, so please do not take anything to be construed as specific financial advice to you. We are financial advisors, happy to help you as well. But anything you do is your own. But we will be talking about investments today, and all of them have risk. And of course, past performance, although mine is very good, is not indicative of potential future results, although it's a very good indicator in my opinion. So that's my disclaimer.
Dude, you've perfected that disclaimer.
Well, it's such a ridiculous disclaimer that past performance is not indicative of future results. There is nothing more indicative of future results than your past performance, actually. But it may not be true. I may all of a sudden have a turn after 28 years and start doing really crappily for a long time. It happens.
What do you think about Kathy then? Because
Exactly.
Kathy's been having a year, man.
Exactly. Well, okay. So I want to preface this by saying we're investors in ARK. At my firm, we've had at times millions and millions of dollars with ARK. We very much work with them. And when I went through my experience with Tesla, Kathy and the ARK team was one of the only teams that we worked with that got Tesla, that made a lot of money on Tesla like we did, and we supported each other through a very hard time. So I'm very grateful for my relationship with ARK, and I have tremendous respect for their team. So I want to preface it with that. But I think they've kind of run into this wall right now, and it's crushing them. And I haven't seen this level of missing where the market is on such a degree from such smart people in a long time, because they've underperformed the S&P by like 40 or 50% this year.
Substantially.
I mean, like that, I've never had that happen. Like, I've had bad years, for sure. But to diverge so much so from the market without really reassessing what the hell you're doing is the part that I'm concerned about. Like, she's doubling down on what's not working.
Yeah.
And I went through a stretch in the end of 15, 16. So in 2015 into 2016 was a really hard stretch in the market. And I was cold. Like, we were over levered in tech, and the tech market got hammered, and we were down hard, like, sucks, right? Because when you're in tech, like high PE tech, and things go down, there isn't like a dividend that's going to save you. Like there isn't earnings, that are going to save you. So it's all the perception of that business future. And so when things get tough in tech, the values can keep going down and down. And I would say that with ARK today, even if you look at our current holdings, they can keep going down because none of them are even cheap of what she owns today. Yeah. So there's been no adjustment to the realities that we're in a compressing PE environment over the next couple years. And when PEs are compressing, your earnings need to be going up a lot to justify them. And that's why we use a thing called the PEG ratio. PE to growth rate is the way we value companies, not just like what we feel their future innovative value will be in 5 years. And so, they need to readjust what they're doing right now, and they haven't done that yet. And I think they're great investors, and these are the kind of shocks that force you to readjust your thinking, like I did in 15 and 16. And by the early 16, I was like, I'm not doing this again. Like, I've made some mistakes here that have cost me money. And one of those mistakes is exactly what Kathy's doing right now, which is you don't adjust to the fact that what was working great for you isn't working anymore. And you got to kind of like if you sold everything and started rebuying, would you rebuy back all those stocks again, exactly in the position she has? I doubt it. I doubt it.
That's a good point. So do you think people get stuck where they're like, I hope it goes back up. I don't want to take the loss because I'll feel like a loser. So I'm just going to stick with this. But if they just sold everything and reallocated, they'd be like, yeah, no, I'm not going back into that.
That's exactly the biggest mistake investors make. If, I like to educate people about investing. Like that's one of my favorite things about my position, because I've been doing it my whole life. And I've made like every mistake, right? Like I've made every mistake to some degree at some point. And ideally you minimize the pain of those mistakes. Okay. And one day I'll write a book about all the mistakes you can make investing, which is definitely a book worth. So static thinking, like the idea that what we thought about a year or two ago is somehow still relevant, is actually like a mental comfort creator. In other words, we don't like the rapid change that's constantly happening in the world, and markets reflect those changes. Just like the last month or two, you're getting hammered because Omicron's coming up. Okay. Yeah. So Omicron comes around and everybody gets fucking scared. Okay. This is opportunity because it turns out Omicron isn't that scary. Okay. Right. So it's a short-term event that's created a lot of stress in the system, legitimate stress. But who wins here? Okay. I know who loses. The cruise lines. They lose. It's like 86 cruise lines filled with COVID passengers. It's not a great business anymore. It's just not. But who wins? Okay. Who wins? Because Corona's been a huge winner for the economy. Let's be real. Let's be real. If anything I was wrong about in 2020 was Corona. I thought we would have the worst bear market ever. I took many steps to protect my company that I thought things would be horrible for till now. But we've ended up having the two best years of my career.
Right. That's amazing.
Okay. So my thinking, the way I think, and I was talking about this last night because I watched this Elon interview, and Elon and I are very different. I'm much more like a jazz musician, and he's an engineer. So my mind tends to like bounce around in lots of different places, and he's like laser engineer focused, like building shit. And so flexibility is sort of my hallmark. Like I'm very adaptable. Like I've been doing this a long time. Things are going to change. Now everybody's talking about NFTs and the metaverse. 6 months ago, nobody said a word about this. Nothing changed. Roblox was here. Everything was here, but it becomes popular. And then it's a concept. And then it's an investment theme. And then investors need to say, if I'm not in this theme, I need to take a look at this. Not just immediately just go, oh, it's a metaverse. We're not living in the metaverse. Forget it. And that closed-mindedness hurts people. Now, what happens is if you're a winner in one area and you're really good at that, and you really reinforce the winning from what you're good at, it's real hard to change. It's real hard. So for her, she's all in on innovation. I want you to explain to me how Roku is innovative. What exactly does Roku do that's innovative in any way? And this is like her number 2 position. There's nothing. In fact, Roku is like uninnovative. It's literally a copy of every other TV set and Apple TV, and they don't even have their own content. And YouTube pulls their content, and the thing is worthless, basically, is what we learned. Okay? So it's a way to watch YouTube TV if you can't afford a Samsung. That's
and then Roku. The YouTube ads, not necessarily the Roku ones.
Right. And YouTube is what you want to own. Right, wow. Kevin? You want to own YouTube.
Got a lot of Google stock. I keep adding to it, too.
Did you really pay $11 million in taxes?
I will be. Yes.
Because then I want to own YouTube. You know what I mean? And like Google, if that was her number 2 position, like my friend Gary Black's, who also has a fund like mine, that's a future innovative fund.
The future
like
fund,
mine.
That's right.
The future fund. So Gary's like one of my good friends in investing. He's one of the smartest people I know, and he knows Tesla in a different way that I know Tesla. So it's really great when we work together because he's great. He's just great. So his fund, number 2 position is Google. And I called him the other day. I go, why Google? All of a sudden Google is like, listen, it's a benchmark and we all compare to this benchmark, which is the same reason we all own Google. We have to because it's so big in the benchmark. So this goes into the thing you were just talking about is like, I'm getting killed in small caps. I'm getting killed in mid caps, but here I am in large caps killing it. Like, why is that? And there's a reason. Because that's cash for people now. People don't hold cash.
Yeah.
So funds like mine, funds like Gary's, instead of holding cash, we hold Google and Apple.
Yeah.
So when you see those stocks rising and the overall market falling, everybody's like trying to analyze this. It's actually just cash. Like a lot of investment people don't understand this concept that we don't hold cash at my firm. We just hold other securities, you know?
This one right here. I have my little spreadsheet, my portfolio spreadsheet. This is Apple right here, Apple. And I'm at 2.78%, but I put up to 8% cash hold is what I have written there. Same concept. Yeah.
But see, you're underweight Apple, so you're going to underperform the index hard here because Apple's actually doing pretty well. And Apple's let's say, like a 4 to 6% weighting even in the index, in the S&P. And if you're in the IWF, it's like a 10% weighting. So essentially, if you're not like 5 to 10% weighted in Apple, it's super hard to outperform the S&P. So like you have to make this decision as a fund manager. And we kind of walk the line of we want to have weightings close to the big cap weightings of the companies we like in big cap. Because if we don't, we can't outperform because everybody piles into those things when things get tough and then you underperform. It's like, it's so fucked up. Yeah,
so I want to ask you though.
So yeah, so you're underweight you're going to underperform if you're underweight to Google and Apple.
Well, unless you're way overweight on Tesla, like 40%, but
yeah, like we are.
Yeah. So isn't it possible though that, you know, using your analogy, Kathy Wood is that laser focused engineer, and that because she's doubling down on what right now are losers, she could be setting up for that triple or quadruple, whereas we're setting up for the 10 or 15% maybe if we're trying to go for those benchmarks.
Well, right. So there's a home run hitter, right? The home run hitter doesn't swing for doubles and singles. I'm not a home run hitter by nature because I think that's a really hard way to invest. So the way I do it is I like to hit lots of singles and doubles, and then I put out some good hitters out there too, you know. But really the game is betting when your home run hitter is hitting home runs. That's when you want to bet big on your home run hitter. So it's really, if all you do is swing for the fences with every player, you know, you might hit a few, but it's not going to be consistent. What it's really about is betting on the right players at the right time when they're doing well, you know, because if all you're doing is hitting home runs, it's real hard because a lot of the days, like I'm just hitting singles and doubles and I'm happy. I'm happy if a couple of my positions outperform and then I'm looking for the next Tesla. So I know Tesla is not going to be the next Tesla. So like I'm looking for the next Tesla. So I spend most of my year looking for the next Tesla. And typically in a year, not that I'm going to find the next Tesla, but typically in a year, I have about 4 or 5 really good stock picks over the whole year. So like those I have to maximize. So if I hit something right here, like GGPI, you know, I really like Polestar, $11 stock, SPAC. SPAC will finish in Q1, Q2. It's a great company. They're delivering cars. The demand for cars is off the charts. If you can make a car and deliver a car, it's sold. We were looking at used cars today. Like all used Teslas cost more than new Teslas. Like you can't buy a Tesla for less than a new car price. It's insane. It's insane. And like these haters are like, oh, you're using Carvana. So I like went to 5 different sites. And I was like, dude, everywhere you look, a Model Y costs $60,000+ used. I know. So Polestar can make 30,000, 50,000 cars a year. They're sold. Well, Rivian and Lucid can't get the cars out the fucking door.
Right.
So Polestar, you know, maybe that's a big winner. I think that's a 3 to 5x in 5 years if they can deliver. You know, so you got to find the next big winner, and that's the challenge. You know, who's that going to be? Who's going to deliver? Who's going to come through? Because certainly the fintechs have dissed me this year. You know, you go into Square, PayPal, and Coinbase have just been dogs in my portfolio. Well, crypto's had a good year, you know, and so we've had a tax loss harvest out of ARKF. We had a tax loss harvest out of Square and PayPal. We'll be back in these positions. We didn't tax loss harvest out of Coinbase because I'm most bullish on Coinbase. But, we're going to buy back these positions in 30 days, but it sucks.
So when did you guys close those out?
Oh, sorry. We're still closing them.
Oh, okay. Okay. So do you think we're seeing that broadly in the market, that people are just like, the closer we get to the end of the year, we're just going to keep seeing pain, and then it might take 30 days for them to actually start running again, or people just switch into an alternate, fintech. Like if you're in Coinbase, maybe you go into, I don't know, Square or PayPal.
Well,
or
institutional players don't do that because they can't. Individuals can. So this is a real advantage of an individual investor versus an institutional investor, is like, I have MSOS in my fund and I can't just sell it and buy YOLO, for example, and just take the tax loss harvest. I mean, I guess I could, but it's like this whole thing, but like in my personal trading accounts for my clients, we can sell MSOS and buy Curaleaf, or sell my Curaleaf and buy MSOS. And these tax loss trades are very helpful. So in funds, it's harder to do that easily. Versus
is that because in like the ETF, for example, that you have, aren't you tax advantaged anyway, to where you could trade and you're not really distributing taxable gains anyway? Or how does that work?
You're not tax advantaged in theory, in the sense of like, if I still sell my Tesla at a gain, it's a taxable gain.
Right.
They have this loophole which I was kind of wondering why Kathy's even distributing gains, because it's like, we have this loophole. Why are you even distributing any gains? Like, that's also a question I have, because the way I see it is, if I had this big run up in Tesla, what you do is, it's like a 1031 exchange in real estate, where you take your asset and you exchange it for other stocks. So you don't actually sell the stock. And that's why ETFs have a tax advantage, because you don't actually have to sell a stock. You can transfer its value to other stocks tax free. And that's how the indexes rebalance without causing taxes. So ETFs in general pay no taxes, while mutual funds pay anywhere from 2 to 5% of their assets or more in capital gains distributions, which causes a 1 to 3% tax cost for clients, which was one of the reasons I started an ETF, was for my clients, to avoid that, because this is the time of year my clients have to call me in a month and say, I need money to pay my taxes because we had a good year. We had more gains this year. We got gains. And we got to pay taxes. And so the ETF will help us avoid that over time. Very excited.
Okay.
So my ETF is distributing no gains, and we have a small dividend.
So to kind of depict that, what you're kind of saying is, let's say someone's an investor and they invest in GK, and it goes from $23 to $28. That's like a 20% gain-ish, a little bit more. Let's say now it 25%, whatever. Let's say now they sold this, they pay taxes on this gain here. But in the meantime, what you could do is, let's just say as an example, Tesla doubles. You're not passing along that if you end up essentially selling half of that, but not really selling it, trading it for, let's say, Apple, Google, and Enphase. You're not passing along that big tax burden over here. It's all on when they sell. Is that what you're saying?
Right. And I'll give you a perfect example of where this works, because one of the neat things about the technology we use at my firm is we can aggregate the investments of all of our 8,000 clients into one portfolio to see what our 2.2 billion looks like as a whole. Okay. And what it does is it shows us how much unrealized gains we have in the current positions we have, which at the time is like hundreds of millions.
Sure.
It's like, I think we have like 700 million plus in just unrealized gains in my firm right now. So that's the problem, though, because there's a $300 million tax bill embedded in that. You think I pay a lot of taxes for that? You think I'm helping the government? You know what I mean? So I don't want to just give that money away. So I have to use tax strategies like donor advised funds, or like, or you just hold it. You just hold it, So like Tesla, it's no brainer. You just hold it, but you're stuck with a big allocation of Tesla for the rest of your life,
Unless, of course, you're an ETF, and then you can do that trading and that balancing, and then that's done for you without taxes to you, right?
That's right. So now let's take this back. If I would have had an ETF instead of managing individual client accounts, and now my ETF had 2.2 billion with the same 700 million in gain, and I wanted to get rid of that 700 million in gain without creating that 300 million in taxes, what I can do is transfer all those gain stocks into new stocks without creating a taxable gain.
Dude,
and it'll save my investors, in this case, 200 to 300 million.
Why?
And that's
why
I did.
Everybody just like make their own ETF for their day trading and their trading? You know, it's like, oh, because I mean, I had quite a few.
Because you're not an investment advisor, and it costs money to have an ETF. So if you don't have 25 million in it, you don't make money. And then there's regulatory, and you have to follow 1,000 rules, and there's you have to have custodians that will work with you, and you have to have a track record in the industry. You know, there's a lot of hoops. But there wasn't even active ETFs invented till recently. We're the only ones. Yeah. Like Gary doesn't have a firm. Gary just is ETF. We're the only investment firm, RIA, that started its own ETF for the benefit of its clients. Now, I don't like to promote it too much in this sense because I don't want Elizabeth Warren figuring this out and then going after this tax benefit, which they very well could. They very well could. But it would hurt Vanguard. And Vanguard is probably the largest contributor to Elizabeth Warren's, life. Who knows?
Good point. That's really interesting. So that's very interesting about the taxes. And it makes sense why not everybody can do it or you just pick an actively managed fund to go into. What I want to jump to this idea of rotating. How do you handle when you're looking at, I just did this math. All of the companies, like of my portfolio, about like 19, no, sorry. It's
how many stocks do you have?
Like core, probably 12, 14.
Okay.
And so of those, about 10% is small cap and fintech. And those are just getting obliterated, like absolutely destroyed. And so I realize, and I've noticed this for weeks now, that small caps are like the butt of the market. Everybody's shorting those to hedge their big ones, and people throwing cash in the big. At what point is it just make the shift, like take that 10%, put it into Apple, and then just buy it back later, versus just like, but what if I'm too late? And then you just kind of sit there and you watch it continue to bleed. Like at what point are you not too late, right?
Okay, so what's your sell rule?
Sorry, say that again.
What's your sell rule? When do you sell a stock?
How
much are you willing to lose before you sell? Did you sell AMC? Do you still own AMC? I think you bought AMC around 50.
Yeah. Well, see,
do you still own
AMC is unique because
I don't want to hear about unique. I don't want to hear about a fucking movement. The movement's bullshit. I'm sorry. There's no
I know
movement.
You think that, but
no. Stocks are stocks. Okay. There's no movement.
I made a commitment not to sell those. Let's use a different example. Let's use Robinhood.
This is my point.
You love Robinhood.
This is my
bag on one.
The stock market is not a place for morality and ideas. It is not a place for the stand to save the theater world. That is not how you do it. The stock market
right,
doesn't give
Ross.
a fuck
You're not
about
wrong.
you. It doesn't
make
care
fun of
about
Robinhood
you
instead.
No, listen. It's really simple. Okay, it's a number on a screen, and if it keeps going down, it doesn't matter what the letters are next to it. You're attached to a number on a screen. Okay, it's like an NFT. It's like just sell it. It's digital. Okay, so think about it this way. I have a rule. It makes it really simple for me. I sell when I'm down. 15%.
So what is your number?
I'll lose 15%. Sometimes I lose a little more, and sometimes I buy because I'm so convinced that this stock, not because of a movement, but because the earnings, like my Petco investment right now that I'm down on, that I love. And I think it's so undervalued, I just bought more even though I'm down on it. Okay? Now, I still tax loss harvest a little bit of it, but it's like that's the rarity where I'm so convinced that the stock is a buy that I'm buying it down. But 95% of the time, if I'm down 15%, I sell the stock. I don't care what it is. I just sold Square. I love Square.
I just sold Square too.
Right.
Well,
you and everybody else, dude. It's down $8. Okay. We all lost on Square. He changed the fucking name to Block. Like, I don't understand what he's thinking. Change the name to Block. The stock goes tumbling. I'm out. It has nothing to do with whether I like Square. I will only lose so much on a stock. And by doing that,
15%?
you take 15%. And by doing that, you take all this emotion and thought process out of it. And what you'll find is 75% of the time, you'll save yourself from losing a lot more money. 25% of the time, the stock will recover. But that's okay. That's okay, because more likely than not, it's a good sell. Okay? So a lot of hedge funds, and I want you to think about this, they clean all their positions at the end of the year. Sell them all.
Wow.
Because they want to realize profits so they can take their cut.
Yeah.
And they want to start like Tepper does this. David Tepper is one of my favorite traders of all time. Appaloosa Management. He's kind of owns the Panthers now, and he doesn't really trade for the public anymore. He closed his fund and made too much money, and now he just likes football. So this guy, David Tepper, is a genius. He's just a genius trader, like flat out trader. And he used to do this every year. So he starts the year January 1st with cash. So the way his thinking isn't constrained by gains and losses and his previous investments. He's like, now, this year, January 1st, what's going to go up this year?
Okay.
And that's the way you have to think about it. Because this year, there's going to be 5 stocks that go through the roof. Through the roof. I don't know what they are.
Robinhood.
5. I don't know about that. You know, me and this guy, Adam Singer, were debating Robinhood versus Coinbase yesterday on Twitter. I own Coinbase. I think Coinbase is a winner. I think Coinbase is a winner because it's management. The guy who runs Coinbase, this Brian Armstrong, is a winner. Okay. He's just so good at what he does. Vlad is one of the worst CEOs in America. Okay. So when you're investing in a company, you're investing in management. And management is one of the most important parts of the investment process and where I spend the most amount of time, actually.
Wow.
Yeah. Analysts send me numbers. I got analysts all over the place. Send me numbers. I got the numbers. Hopefully you're right, even though you're mostly wrong. Right? Every quarter, beat the analyst, beat the analyst. I just got all the analyst numbers for Tesla. Now they added standard deviation of 18,000 cars because the analysts are always wrong. So Tesla now added in. It's so funny what they send me. They go, here's the analyst estimates for this quarter, plus the 18,000 standard deviation. So this is probably the right number because they're always wrong about one standard deviation.
Wow.
No, so like, I know what the numbers are supposed to be for every company I own. Great. They have to do that. So who's going to make that happen? Management. That's the way it works. So I'll bet on Coinbase any day over Robinhood. Any day.
Okay. So why not in the ETFs do the same thing? Maybe should Kathy just clean the slate? Kathy, start over. What like, does it matter?
Well, I wanted to prepare for this, so I wanted to spend a little more time watching some of Kathy's recent interviews. So I watched a few of them. Okay. And I know her head of research. This guy who runs research at ARC is a young guy, really smart. And we have very similar like thought processes. Like they are not off like with their basic belief systems of the future. I don't think they're off. The problem is their whole team is young.
Is that Brett?
Just like my team, actually. So my team's young. Yeah, Brett. And my team's young and their team's young. But the difference is I've been trading stocks for 28 years, and Kathy's been doing it probably longer than me, but I don't think she was a stock trader. She started her funds in 2014. She's had an amazing track record. There's no question about it. But a lot of that track record was predicated on gains that she made over the last year and a half, just like for me too, because we were right about Tesla.
Yeah.
So I'm not going to try to pretend that Tesla hasn't made a huge impact on my overall returns, because it has. We've had many other stocks do well too, like NVIDIA over the years. NVIDIA's done just as well as Tesla for us, and it's also a top holding. But I'm just saying, like, you know, you have to understand where you get all this extra alpha. It was pretty obvious. So for me, I look at their team and I say, she said something like, now that we're down, I expect to make 40% a year over the next 5 years. And I said, you know, when the last time I heard that was in the 90s, when Cisco was supposed to do 40% a year for the next 5 years. I remember hearing these about Cisco in like the mid 90s, late 90s. And of course that didn't happen.
Yeah.
Because to do 40% a year in earnings growth for a company for the next 5 years straight, and it's already a big company, is almost impossible. You know, it's like a really hard thing to do. So what happens is they extrapolate out what they think their companies are going to earn in 2026, let's say. And then they extrapolate the values of each one of these companies in 2026. And then they do a 30 PE based off the 2026 earnings. And then they say, if all this happens, our fund will be up 40% a year.
This is Cisco, by the way. Like, ouch. If you bought at any point during that excitement in like 99 to 2001.
You're not back to even.
Woo. But okay,
and
anyway.
At the time that was going up, because actually if you zoom in, it's more, you can see it better, like around that time. Like, because the way it looks now, because you're looking at probably like a 20 or 30 year chart.
Yeah, max.
You know, but like if you zoom in at that time, you know, you see this massive run up in the stock. I mean, just massive. And like what people are saying during those periods of time when it's going up, you know, it's kind of funny to look back because you're like, Cisco was supposed to do, and what ended up happening, like with Microsoft too, is that the company did well, but the valuations became reasonable, you know? And so the predictions weren't so wrong, although some of them were, but the valuations were wrong. And so people didn't make money for a decade in Microsoft. People didn't make money ever in Cisco again, really.
There it is.
You know?
There
you go.
So this is the week chart.
Right. So like when you're seeing this massive run up, like how long was that? That's like years. You see that?
The run up really, I mean, look at this. You were $5 in 97. Then you had a little bit of a dip down to 14 after it hit 17. That was in 98. Yeah.
Yeah.
And then look
at
this
currency crisis. That was a 20% decline and tech stocks got whacked. And it was like only a few months. And boy, that was an opportunity.
And then, so if you bought the dip there from 14, it would have gone to 27 to 35. You're already more than a double here. But then
now
look
at
this insanity. 82.
And this was because of Y2K. You know, everybody thought the computers were all going to die. And I don't know how old you were in 99.
7.
Yeah, okay. So when you were my son's age, you know, like it was like a crazy thing. Like 99 was a crazy thing. The market, the NASDAQ doubled in a 6-month period of time.
Wow.
Literally doubled. Now imagine, close your eyes right now and imagine the stock market doubling in 6 months.
Oh my gosh. Yeah.
Right. And people are like, it's a bubble right now. And I was like, no, you haven't seen a real bubble. Like a real bubble.
We're here.
Yeah, exactly. So that being said, I think in Kathy's case, in the ARK investment case, I go through their top 10 holdings in ARK. I can't justify owning 6 or 7 of them. You know, like Teladoc. What's so great about Teladoc? Like, I don't know any doctors that use it. Anybody can set up like a streaming, like a lot of doctors are just using FaceTime. You know, doctors are the worst at implementing technology of almost any group of people in history.
Wow.
Like, really? So like, why is that such a big position? Like, what does Twilio do? They send you text messages to confirm that your device is safe or whatever. Like, how is this worth, you know, so much money? They've never made money. So my whole point is, I love Kathy. I would love to hear why they think this is so great.
But Ross, the company says that they're innovative.
The company says that they're innovative, like ARK or Twilio?
Both.
Well, Twilio was innovative. They innovated the idea that you could get a message back with a number on it that would somehow make something more secure, which actually really doesn't. Authenticators work better than Twilio. I use Google Authenticator. I don't trust 2FA isn't trustworthy. Okay.
With texting.
Like, oh, here's the security code. Your account is now safe. They take over your phone. It's called a 2FA attack. They take over your phone. They 2FA all your accounts. They change all your passwords, and you're screwed. So 2FA is a huge security flaw. So I'd love to talk to Kathy. because she probably has never been hacked before in a 2FA account. And we can talk about the enormous security flaws that Twilio has. Enormous. It just doesn't work. Okay. If you want something secure, Google Authenticator, right? You got to use Authenticator apps because the phone systems are easily hackable.
Yeah.
Easily.
What about cybersecurity? Are you getting into those stocks at all? Like the Cloudflare, CrowdStrike, they got some crazy valuations.
We own CrowdStrike, and I have never made money in cybersecurity. Okay. I literally hate this sector because it seems so obvious that you should be able to make money here.
Yeah.
And I only own CrowdStrike because I feel this way, and I still haven't made money on this dog. But like, CrowdStrike's a great company too. But like, what happens is, I think with cybersecurity is it's so expensive to hire the engineers that they make all the money, and that the shareholders, the shareholders just don't make the money. They don't make money. None of them do. None of these companies make money. So
did you see?
I guess
Apple,
it's just not run for shareholders.
They just paid the $180,000 in stock bonuses to I don't know how many employees, but a lot of them, just to retain the engineers.
Yeah, on top of the Apple walkout a week before from the Apple Store people who are complaining they don't even have benefits and they don't even have pay. And I'm tweeting like, Tim, just pay these retail people some money. They're risking Corona to fix your iPhone. Like, these companies are so cheap. For them to go to $20 to $22 an hour, it's like, oh my God. And then a couple guys leave for Facebook and they're like, 200 grand, 200 grand, 200 grand, like nothing.
Yeah.
And it's just exacerbates wealth inequality, Tim. Yeah. Mr. Social Justice Engineer. I'm an Apple shareholder. Apple has plenty of money. Give those people raises at the stores, period. Give them raises at the stores. Man.
I was looking at, after I saw that, I was looking at automation companies for like robots and stuff like that.
Yeah.
I don't know if you saw it, but I tweeted that I looked into ABB and I read their last earnings call, and they make robots to basically either help employees or make companies less reliant on having as many workers. So anyway, I read their earnings call, and the executives at least 3 or 4 times in the discussion respond to analyst questions with, yeah, we want to make more robots, but we can't find the workers to make the robots. So,
the workers are actually right down here in Mexico, and they're just waiting to get their visas. But we have a system in America where we have a labor shortage, and we have unlimited supply of labor at our borders that can't wait to be Americans and pay taxes. But the Democrats, Biden and Harris, my party, our party, the party of immigration, can't seem to fix this problem. It's infuriating. It's infuriating.
You nailed it, dude. You know how, I'm sure you probably do, but I tried hiring somebody from a different country. I'm like, hey, you've got the skills. We got a relationship. I want to move you out here, pay you a salary. You'll make good money. You'll contribute to the economy here. Like, you're not going to be on social services. It'll be great. You look at the rules for trying to pull that off.
Yeah,
unless you got like a PhD, forget about it. Yeah, it is so hard.
H1b Visa, we used to do this a lot at my firm, and it's a nightmare because the legal costs for the immigrants are so high. So it costs $5,000 to $10,000 in legal fees just to do this H1b thing. And so companies often pay for this. Right? Well, you have to qualify. You have to also prove that there's nobody that you can hire in America that has the same skill set, right? It's like this whole thing. And then there's a limit. So what the tech companies do is they file the first day of the year for all the H1b visas, then they're gone and nobody else gets them except tech companies. Okay, so I think Biden said he was going to add more H1b visa people, but it should just be unlimited.
Yeah.
Right?
Yep.
Right? So
absolutely.
If this goes into, sorry.
I was going to say when my father came here from Germany, he and applied for a visa and eventually he got his green card. He had to sign away his rights to get social services. No unemployment, no benefit, nothing. You want to come here, you work and make it work. This was back in the days of the INS, with the naturalization. I don't even know what it stood for, whatever. They don't have it anymore. Now it's all Department of Homeland Security or whatever. But to me, like you say, open it up, let people come in, and then let us build more homes easier, more easily, so we don't have a housing crisis at the same time.
How
And then the
about
economy
labor,
will
right?
explode.
Totally. Like there's 70,000 Afghan allies we have waiting for visas, hiding from the Taliban right now. We literally have tens of thousands of people who couldn't be more wanting to be American, couldn't be more loyal to our country, risking their lives to fight the Taliban for us. And they're waiting in refugee camps, hopefully to get in because of red tape. But I can't find anybody to build anything.
No, it's so bad.
So the Democrats have failed this country. You know, I worked super hard to try to help win this election personally, like work super hard to help Biden and Harris win this election, and they have let me down. They should be letting these people in left and right. Okay. I mean, just this whole administration, they blew this Build America Back Better plan because they're pandering to a bunch of progressives that are so stupid and regressive with the policies that they want to bring America back to an age where we were poor. And
Dude.
like Biden doesn't have the cojones to go out and say, hey, you know what, AOC, I like you and you're smart, but you're young and you're wrong. Okay? This is not how you build a country. I want your help, but you're not right. I'm 78 years old and I know a few more things than you. Okay? But AOC is a very smart woman, but she doesn't know what she's talking about. Okay? And so it's like, it's time that leadership lead.
No, I honestly, I mean, I couldn't agree more with you. The extremeness that we're getting out of Elizabeth Warren, the AOC is punishing to entrepreneurs. It's punishing to people who want to start a company, to people who want to prosper. It's you know, I did a financial breakdown on AOC, and then we'll get off the political stuff. But I did a financial breakdown, and you know, she's always cheering.
You're losing subscribers.
Whatever. You know, she's cheering cancel what is it? Cancel student loans. And then you look at her financial breakdowns. She basically has no investments. She's been in Congress, you know, for 2 years, making 190 grand salary, spends it on clothes, a fancy luxury apartment, and Tesla. Doesn't have any investments, but has somewhere between $15,000 and $50,000 of student debt. And all she's cheering for is let's cancel student debt. I'm like, this is the wrong example for America. We should be teaching work hard, save your money so you can invest, not blow it all on fancy dresses and cars and luxury apartments. It's backwards.
People who don't pay their taxes. Right. And people who don't pay their taxes and then go to the Met Gala, which is the most stuck up place you could possibly go. You know, it's like, it's just, have you seen Don't Look Up yet?
No.
That's on Netflix. Watch it tonight.
Okay.
It's
Is that the Leonardo DiCaprio one?
Yeah. You know,
oh my gosh, I saw a clip of that where Leonardo DiCaprio, we're all gonna die. Our administration sucks.
I'll tell you a story. I'll tell you a good story. I got to hang out with Leo DiCaprio twice in the last month. Just me and him drinking scotch, talking about climate. And it was amazing.
How'd you set that one up?
Well, I was pretty lucky because, you know, I'm in the big business world and you know, one of the investments I have in Polestar, Leo is involved with Polestar because he's working more on climate issues. So Leo is legit. He's not, what he cares about is climate. What he actually cares about, like as a person, is climate. I think I was super impressed. Like, so when I met Leo, it was in like a kitchen of this guy's house.
Okay.
And I'm with my wife, you know, it's kind of funny. And I was like, Leo, you know, like, I was like, you know, Jeff Bezos sent me to talk to you, you know, and he started laughing. And I was like, if you took a picture with me and my wife, I'm sure it would go viral. You know? And we were laughing. And I didn't bring up one movie. Now, he's one of my favorite actors. I didn't bring up one movie. We didn't talk about anything like The Departed or any of this stuff. What we talked about for an hour was climate change.
Wow.
And he wanted to know. He wanted to know more about EVs. He wants to do more. He was just at the climate conference. So we were talking about how the politicians aren't going to solve climate change and that actually influencers, actors, business people are the ones that are going to have to take the lead in solving climate by making it worth it to solve climate. And he was just doing this movie, and it wasn't out yet. And now that the movie's out and I've seen it, I totally get where he was coming from now, because this whole movie is based around this concept that the politicians and the government are so stupid and concerned about so many of the wrong things that they're not solving any of the issues that need to be solved. And this movie does a wonderful job displaying this. And it's on Netflix. It's really great. But Leo is a great guy. I can only say positive things about my interactions with him. I think that he's one of the greatest actors of our time. And I love that what he cares about are human things. He's one of the few people I've ever met in Hollywood, and I grew up here, that I've ever met who's as successful as he is, who all he wanted to talk about were like meaningful things. I was like, I love this guy. Like, we don't have to talk about bullshit. Like, we had the full combo. So, you know, I'm really into Leo now.
Wow. That's really awesome. That's a good recommendation for the movie. So what is it that you see in GGPI? I'm pulling up their S1, their quarterly reports aren't as detailed as like why, like I get they're delivering cars, but no, there is no, and this is a core demo here. Okay. There is, and I know this is anecdotal, but I'd love to see the stats on it too. There's no 25 to 45-year-old dude going, gotta have the Polestar.
That's right. That's right. Because they haven't driven the PS1. The Polestar 1 is one of the sweetest cars out there. It's just expensive. So Polestar has 5 models they're building, and they're copying Tesla basically with a Model 3, a Model Y, like a Model X, and then a Model S. So they've got kind of the same idea of Tesla of serving all those same markets. The Polestar 2, which is the Model 3 version, is a pretty sweet car. It's much better than the Mach-E. It's a very well built car. But remember, these are the Volvo people. Volvo was never known for being the hottest, sexiest car. It was known for being a good, reliable car. They're good at building cars. And the Volvo people are very understated. This is what I'm trying to help them with, is to be more, you know, big and talkative like Elon so that people pay attention. The Polestar 3, I've seen, because they launched it in New York. That's why I was out in New York. And the Polestar 3 is like the Model Y, and it's sweet. It's sweet. So it's coming out next year. They're building a factory for it. That'll be the game changer product for Polestar. It's not out yet, and people haven't really seen it, except for me. And it is in the videos from the event, which are open to the public. So I haven't seen anything the public hasn't seen. The Polestar 4 and 5 is where it gets really interesting, because the 4 is like a Model X and the 5 is like the Model S. And the Polestar
and those aren't
5,
out yet, right? I'm just
no, they're going to do one car a year. That's their goal, is one car a year. The only reason I like Polestar more than almost every other company is because they can deliver cars. They can deliver these cars, and they're delivering them now, where Lucid and Rivian have not been able to. And they're valued at 2 to 3 times what Polestar is, but they've been unable to deliver cars. So if you have a wonderful product, but you can't deliver it, it doesn't help you at all. But if you have a good product that you can deliver, the demand for EVs and cars in general is so large right now, globally, that it doesn't matter. They're going to sell them all. Secondly, Polestar's main market isn't the United States. Polestar's a European company. Their number one market is aiming to be Europe with 40% of sales. It's owned by the Chinese, so 30% of sales is supposed to go to China, and that's the secret. By being owned by the Chinese, they have the supply chain for batteries. They have the supply chain. And that's why Tesla is going to blow out their numbers this quarter, is because they have a better supply chain because of China. China is the EV supply chain. There is no other path but through China. So Geely owns Volvo and Polestar. So the Chinese have every incentive to see Polestar succeed. The Europeans have every incentive to see the Polestar succeed. These are the people you want. They know how to make cars, and they've got the supply chain, and they got a stock price at $11. I'm in. Management's great too.
So let's touch on China there for a moment. You know, a lot of fears that Evergrande obviously has defaulted. We got another big bond payment due on Tuesday. You've got the real estate market that's substantially stagnated. You know, you've got the politicians in China and Evergrande saying, "Oh, don't worry, we're getting back to building the units that everybody was promised. It'll all be fine." Well, what if it's not? You know, what if we see contraction in the Chinese economy? How much is that going to weigh on us? Is that going to crash our market here?
That's a legitimate question. So I don't want to say no, that it won't, because it very well could. And since this is recorded, I don't like saying things that I might be absolutely incorrect about, especially when I think that's a possibility. China's different than the United States in that they manage their own economy, and they essentially could go to people's houses door to door and force them to buy things. You know, it's like, you know, it's a fake economy. It's not like a real economy that's an open economy like what you would study in school. Everything's owned or controlled by the government in some way, shape, or form. So to some degree, that protects them from the downside, because basically the government loses if the people lose, and the government can just print more money and the people have no choice but to use it. So as long as you're not involved with that nightmare, it doesn't hurt you. The issue is Chinese consumers and making sure Chinese consumers have the money to buy U.S. goods. And what we've seen over the last 5 years is Chinese consumers have been shunned away from U.S. goods as part of the strategy in China to become more powerful internally and build up their own companies. For example, at Apple, for example, you know, they very much, when we started the cell phone wars, they very much encouraged Chinese people not to buy Apple anymore. And we saw Apple sale dip, and then it kind of like leveled off, and now they've come back again. You know, so I'm not too scared about the Chinese economy because of its size, depth, and growth potential, and the fact it's manipulated 100%. So if everybody's fine with that, then it's fine. Where it hurts is if you're the investor in China that's not Chinese.
Yeah,
China's not investable for U.S. investors right now in our mind. We have no Chinese investments. I would highly recommend somebody reassess their understanding of the Chinese culture, because it's not about making money for shareholders. China is a communist country that believes, and very much what she believes is what's for the benefit of China. And what's for the benefit of China isn't making a bunch of outside shareholders rich.
right.
So nobody in China wakes up and says, we want to make sure our American partners make a good return too. I would say 0% of Chinese businessmen think that way. And I'm sorry, that's just the way they are. You might not like what I have to say, and I don't care. I don't do business that way. And I'm not in China in any way as an investor. And it spared me a lot of losses this year. And I looked at China the other day because it was cheap. And it will be a very big growing economy forever. But it's like anything else. It's kind of like those stocks we were talking about in the crowd strikes of the world. If they don't care about the shareholder, you won't make money. And that's the problem.
Yeah.
Companies like Apple care about the shareholder. They wake up every morning, they want to make shareholders happy. They know shareholders run the company, and they're all overpaid to make shareholders happy. But in China, they have no such desire, no mandate to do that, and no historical precedence for it. So I would be very careful as an investor in China.
So what about, I mean, really what it sounds like what you're saying is, look, it's still going to grow. It'll grow slower, but we got to watch that Chinese consumer, which what's interesting is if the Chinese consumer stops spending, you know, that slows down the GDP in China. We're kind of seeing reports now that we're seeing credit card transactions plummet, according to JP Morgan. With this Omicron.
Well, they're going to get hit by Omicron. They're going to get hit by Omicron.
Them too. But coming to the
their
U.S.
strategy isn't going to work.
Do you think we could see a similar kind of weakness in U.S. consumers in like Q1? And is that going to weigh on the stock market to where we basically either trade sideways because we've got earnings that are missing, consumers are weak or whatever, and then rates go up, or are we just going down at 2022?
All right. So let me cheer you up on this idea. Americans are nothing like Chinese people. Okay. Americans aren't anything like Chinese people. We're culturally, every way, we're opposite in a lot of ways. I don't know how much you go out. You're a married guy. You know, I don't know how much you go out. You live in Ventura County. It's boring. Okay. So like
You haven't been out with us.
No, you guys are fun, but like Ventura County is Ventura County. It is what it is. It's nice, but it's not exciting, you know? So if you go out, let's say Venice, California, which is freaking happening right now, it's happening. Now, granted, this week is Christmas, but like if you go out in LA, it's packed. People are going off. People are going crazy. And Omicron comes. Nobody wants this shit. Nobody wants to change their plans. Nobody canceled their ski trips, you know, and everybody's getting Omicron and nobody cares and nobody's dying, you know, that I know. Everybody's got it, I know. They're all better now. And it's like, nobody cares. So what I think we're going to see is a slowdown that we're seeing right now. It's just because so many people are sick, they can't spend money when they're sitting in bed. But they're only sick for like 3 days.
Yeah.
And then it's like, oh, I'm fine, but I just can't get out of my house. That's why the CDC just changed the rules. The fucking CDC, what a joke these people are. Oh, you don't need a test and you can leave after 5 days. Worst disease in modern history. But because we need people back to work and we don't have enough tests because we're so negligent that, you know, we're just go back to work after 5 days. So we had a guy at my company get it 10 days ago. He got better. He's still testing positive, and he doesn't know what to do because he's like, I'm fine now. It's been 10 days. I go, well, CDC guideline says you can just leave now, you know? But I was like, don't come in. Just keep testing each day, you know, until you have no more corona in you. I mean, I guess it's still sitting in you. I don't know, man. Nobody fucking knows, right? So the good news is Omicron is the best thing that could have happened to us. Now, I know that sounds weird, but now I'm not a scientist. This is just the way I think. So it's sweeping through the world really quickly right now, and many people don't even know they have it. And what we've seen in South Africa, it's like a really quick rise and fall of cases. So we're having this right now. So please, whatever you do, be very smart on New Year's Eve. You know, so we had Christmas super spreader and then New Year's super spreader. New Year's super spreader can be avoided because New Year's Eve you can choose. Christmas is hard to avoid because it's your family. Okay. So the way Omicron works is 100% of the people around you get it. If you're vaccinated, it's like 50 to 75% of the people around you get it. So in a vaccinated room of 100 people, if there's Omicron, 50 of them were going to get it at least. So all of those 50 people who get it have very mild symptoms and are better in a day or two. That's the great news. But what they're now seeing is Omicron protection helps against Delta infection. And if you have the vaccine and you get Omicron, essentially you'll be able to beat any corona. So this is getting closer to the end game. And what we're going to see is this is going to sweep through in January, February, and by March, it's going to be like a huge party because this really could be much closer to the end now than we've been in a while. So Omicron is the best thing that could have happened because it's not lethal because of all the vaccines, because of previous infections and immunity. So it's taking this time for this horrible disease to work through the global community and morph until it becomes just a normal flu. And it's taken a couple years, but we're almost there. And by next Christmas, you'll see a completely different world. There will still be corona. We're still going to have a surge, and it'll just be less and less every year. And that's why. So this is the last bad year of dealing with this, and it's really the government's been very negligent in many of the things they've handled under the Biden administration. In fact, I can't get the tests that I've had every month to keep my family safe. I literally can't get these tests now. We had to use, you know, unfortunately, because I have connections, we had to because we're trying to keep our team safe. We had to go through the main buyers of a medical company to buy tests in bulk. So we bought it in bulk now. We haven't gotten them yet. Hundreds and hundreds of them in bulk. But I was like, how do I keep my people safe? We were just buying them at the Walmart. It was no problem. And then I told everybody, I go, stock up because this is going to happen. And then it was a week later, it was gone. And now we can't get tests. I just want to test, you know? So Abbott Labs, we've been adding to that position.
Yeah, no kidding. Why not just work from home?
Because it sucks. It sucks.
Fair.
I have been working from home for 2 weeks now because we had a corona outbreak at the firm. We lost 3 guys down. You know, I can't risk any more people. They're all better. They're all fine, thank God. but I run my business to my people's safety first. So we had to shut down. So we're shut down right now till further notice. I don't know. But
Yeah,
I'm not going to tell people not to go out. And
I'm trying to hire folks computer engineers, researchers and such. And it's amazing. We'll get these really good applications, but then they're like, oh, but I don't want to relocate. It's kind of like the tech world is like, I feel like corrupted them to just want to work from home. And I say corrupted because how are you going to run a freaking startup on Zoom? Sorry, Kathy.
well,
Sorry.
look, one of the things I've learned in my life is people love trends that benefit their leisure,
Yeah.
So of course, nobody wants to go back to the office and be forced to work extra hours that they don't have to work at home. We all know you're quitting early at home, so like, I'm okay with the lack of productiveness at home that exists because I have super productive people. And so it's offset a little bit because they're pretty self-motivated. But like, I just think I'm inspired to work around my team. Forget about other people. Me. I'm inspired to work around my team. I am. I like my team. If I don't have my team around me and I'm just sitting here, my wife comes in to check on what I want for lunch, my kids want to throw the frisbee or whatever, like, it's the most boring life in the world. Like, it's just not for me. I go in, I run a battleship. I got 41 people. We're trading billions in stock. Every day is like super fun, so much going on. Like, it's a professional sport, And so like, I'm not playing football from home. And that's the way I explain it to people. Okay. And the way you need to explain it to people. If you want to have an okay job where you make okay money for the rest of your life, work from home. But if you want to join Meet Kevin and be on one of the most influential financial channels on YouTube and build an amazing career and make some real fucking money, get off your ass and come out to Ventura County.
Thanks, man, for saying that. Yeah, I'll just, I guess, quickly shout myself out. If you want to email me, kevin@meetkevin.com, if you want a job.
Listen,
but
I'll shout it out for you. No. Kevin, like, I literally love what you're doing. I think finance on YouTube is a must. I literally cannot believe what they put on regular television for people to watch what they call financial television. I think you do great stuff. I think people want to know. Your viewers and your listeners are very engaged and want to learn and want to invest. And you've done a great job pivoting from sort of real estate, build your own wealth, to real financial planning that really helps people. Not that real estate doesn't. It's just kind of a different thing becoming a real estate investor.
You don't like real estate.
No, I do, actually. I'm making a lot of money in real estate right now. I don't like it for me.
Sure.
But I own Lennar. It's one of my biggest holdings. I mean, build houses, man. I build houses. And I own Home Depot. I mean, it's more that I don't like the people in real estate. Like trying to get something done with a contractor.
Yeah, that's rough.
Nightmare. So that's what I don't like.
Well, on that note, how like, I have this problem that I've noticed, and you would know this because how many employees do you have at GK?
Now 41.
Jeez, man. Okay, so yeah. I want to know, how do you
hiring
find
an HR person?
Well, yeah, but yeah, you got to find a good one. So how do you find people like who are just willing to work hard, give it everything they've got, and then they get promoted, they get raises? Because it seems like a lot of what often we find is people come with the opposite mindset. It's like, well, I should be getting paid more, so I'm just going to work like 25% effort. And then it's like, well, no surprise you're not going to get paid more. If anything, you're getting fired. Like, it should be the opposite. It should be like, let me put those 12-hour days in to prove. I mean, I just gave someone, I just basically tripled someone's salary because they just like, more, keep working, I love that. Right. But it's just, you don't get that from most applicants. How do you handle this?
Well, the truth is, and I've been hiring for 28 years. I went to an Ivy League college. I went to University of Pennsylvania. And one of the first things I realized
so did Trump.
I know. And when I was in college, we used to like try to tear his picture down at Wharton. That's like F Trump.
Oh.
Back then it was like milking, you know. Trump was cool back then, actually, believe it or not. You got me off track now. But
Sorry.
when I was at Penn, one of the first things I realized, because everybody's smart there, you know, it was like the Ivy League schools sort of take like the smartest kid from each city in the country, and then you get there, and all those kids think they're so smart because they were the smartest kid in Poughkeepsie. I was the smartest kid in Milwaukee. I was the smartest kid in Cleveland, and then they get all together. And I always used to laugh about this because you realize you're not the smartest person pretty quickly, you know? Like Elon was there when I was there, so I wasn't the smartest person, you know? So he might have even been in my astronomy class. I don't even know. You know what I mean? And it's like, so when you think about like Trump and Elon in your class or whatever, and you're sitting in school, and so like the top of the top elite of that group of people, I would say a vast majority of them go to pretty middling type work, like MBA work, you know?
Yeah.
Like, so just because you're the top of your class in high school and you go to an Ivy League school and graduate doesn't necessarily make you that motivated to do anything great. So I do think the average person does pretty well there, and they were pretty smart. Okay, fine. But when you're talking about overachievers, there's no correlation between being in an Ivy League school and being an overachiever. That's the interesting thing. So being academically smart doesn't mean you're an overachiever.
Mm-hmm.
In fact, it might mean you're just a conformist. You're really good at just conforming to what people want you to know, and you figured out how to get into the schools you need to get through life. And then when you graduate, it's this shocking reality that everything isn't given to you anymore when you don't get hired at Goldman Sachs, which is what happens to most people. So when you're looking for stars, it's not in the Ivy Leagues. The stars, where I get them, truthfully, is in the Cal State, the UC, the Cal Poly. You know, I love kids that come from middle class backgrounds where their parents they're sort of like hardworking people with good jobs. Like some of our best employees, their parents are like firefighters, police officers, teachers, you know, people who are very dedicated to their work, who are educated, who love what they do and are passionate about it, and it's hard work. So their kids grow up seeing a work ethic. Their kids grow up with a certain set of challenges that they have to overcome because they're not as wealthy as I was, let's say, growing up. Where I was a spoiled kid growing up, and I had to adapt a lot in my life. And I have, but I grew up, my dad's still working today. I grew up with great work ethic from a role model from my dad and mom. So that's a huge thing what we look at. First question, what do your mom and dad do?
Wow.
Yeah. What do your mom and dad do? Like, where did you grow up? What like jobs did you have when you were in high school? What did you do? Like, I was a waiter in high school. I thought it was one of the best jobs I ever had. I learned so much as a waiter. And when people are waiting tables and they're like, I go, listen, this is a great job. You're learning a lot. I know you're a kid, but you'll take all these lessons with you for the rest of your life. I think being a waiter is a great job. It's a great job to learn. Work at a restaurant. You have to work hard.
Oh, yeah.
Get some tips. You know what I mean? So I think if you start with people who are highly educated, who think they're very smart, who are entitled, you're getting nowhere. You're getting nowhere with these people.
See, that's an interesting line right there. I think that E word, that entitlement world, that you owe me kind of attitude.
I did my school. I'm smart. My parents told me I was great my whole life. So what? You don't want to give me $200,000? I haven't worked a day. And you're like, no. What I do is I say, here's what I'm going to pay you, and then in 6 months I'm going to reassess it. And how I reassess that could be any number. Okay, so you prove to me what number you deserve. 6 months. Then they come in 2 months. They go, have I proved it yet? And I go, you're fired. 6 months.
How many people are you fired?
Oh, a week? No,
Shut
it's
up.
not. In the old days, we do it every week. How many people have I fired in my career?
Yeah.
Thousands. What? Probably 1,000. Yeah.
Wow.
I fired so many people. Well, my old company.
Just hard to get but what happens? Like somebody's
it's not a bad thing. It's just like, this isn't working out. there's a level of expectation that we have, and this isn't, you're not comfortable, and it's not a bad thing. Like, we just let a guy go the other day. He's a great guy, and I'm sure he'll do well. But it's just, we have a certain thing, and and that E word kind of came up, and it was like, go back to JP Morgan. Like, you're better off there.
Wow.
You know, it's like,
wait. So they left. I don't want to use the word
they left
cushy,
the bank,
but I'm assuming a cushy job at JPM.
Right.
That might be very rude to say. I'm sorry, but they left that to come like grind with you guys, and it didn't work. Is my assumption.
Right. It's not that it didn't work. It was such a cultural difference from coming from JP Morgan to our firm that the person was shocked. He was just like in shock. Like
because
oh my
you're
God.
crazy, or because
like, we're crazy.
You guys work.
We're crazy. Like, we got crypto, we got ETF, you know, we got stock trading going on. There's yelling across the office. I've told you, it's a battleship we run. It's fun. There's shit going on. This person's got this issue, you know, and we got clients calling in, got money coming in. It's a blast. But boy, it's not like working at a Chase Bank branch. That's for
Okay. All right. So not afraid to fire people, huh? How true is that saying? Like, hire slow, fire fast.
Fire as fast as possible. Fast
Wow.
as possible. So that is the most important thing. Hire slow. So our process takes a lot of time now, and you have to talk to like everybody at the company, and you got to do all this shit, but it works. Not 100%, but it works. The process we've created that's slow. But if it's not working out, it's like, let's just save us all. And I would rather write like a good recommendation to you. Like, I help everybody. Like, if you come work for me and it doesn't work out, like, I'm going to help you get another job. Like, it's not like, it's not a negative. That's what I'm saying. It's not a negative. Like, we did have a negative situation recently with an accountant that we had working for us who pissed off our clients. And I kept saying, you can't piss off clients. Like, we run Disneyland. People should be happy. You know, it's like, we run the happiest place on earth and you're making people sad. And this guy just didn't get it. And he just didn't get it. And I said, if you get one more person complain about you, you're done. Because that's the standard I have. 0 complaints. 0. This guy I fired happily fired. Because
does it ever get better? Like, you know, when you give these warnings, does it ever get better?
Absolutely. A lot of people don't. Yeah, absolutely. A lot of people don't know the boundaries. Like, they don't know. Like, that's what I'm saying. You're trying to educate people how to do their jobs better, not just like beat people up or not yell at people. It's like, if you have a bad situation with a client, I get involved. My partner Danilo gets involved because we want to like figure out what went wrong and like solve it, because we have like no client complaints. Like, we want clients to be happy. That's like our first thing, you know? So like, so what did you learn? Like, what can we do better? And most people actually want to do better. And that's what I'm saying. So we have these meetings and they're a little painful, and then we all get through it. And what happens is they turn out to be much better advisors through these mistakes. And so like, yeah, nobody's perfect. So for what we say in my firm is that if you don't tell us if there's something wrong, that could be very bad.
Yeah.
But if you come tell us like right away, like, here's the issue I'm dealing with and I need help, like, that's fine. Like, we're here to help.
So you're saying,
and I find out, it's like, come on, man.
Okay, so you're saying if basically you're getting screwed because they're failing and they don't even care, like, there might be no hope. But if somebody's like, hey, I'm having trouble, then massage them to where they could get better, kind of.
Yeah, like when I started in the business, I had many, you know, bumps in the road. And I had a manager who I got along with, and like, I would go meet. I remember I used to come in on Friday afternoon, be pissed off about something, and I would think it would be done in 20 minutes and go home. And then we'd end up having like these 3-hour discussions about my career and what's wrong with the company and what I could be doing better. And it would go back and forth. And they were just super cathartic because it made the company better, because at the time, I knew a lot more about where it should be. I ended up running that company in two more years. But it helped me grow because I was a young person. Like, you're 29, like, to just pretend that you know everything and you never need to learn a thing for the rest of your life is stupid, right? I'm still learning it every day. And like, and so it's like, you have to open yourself up to criticism to learn. That's the hardest part. So Ray Dalio writes about this. So he came out with this idea called radical transparency, We tried it at my firm for a week, and it was a horrible idea. Have you read about radical transparency?
I read his whole book.
Yeah. So
Principles.
don't do that. Don't do that. Radical transparency doesn't work in marriage, and it doesn't work at work.
Okay.
And Ray Dalio's had a lot of issues at work recently too. So, so what we believe is transparency, but maybe not radical transparency. So the idea is, if people don't know how to get better at what they do, how are they supposed to do that? And so, like, you have to be able to communicate with people in a way that they don't put the wall up and not hear you. And that's what makes a great manager. And that's the challenge I face as a manager and my team faces, is how do we make people better at what they do and kind of dig deep into what's causing these issues without people turning it off. And that's what happens, is people hear something they don't like and they turn it off and they won't listen because they hear something they don't like because it's critical of them. And I say, listen, I'm on Twitter. There's a million people who insult me daily and criticize everything I do. And I read some of this stuff and I don't cry, or I go, maybe there's some truth to this and I'm going to read it. And so I try to get as much feedback as possible and try to do the best I can, you know, and I think that's what employees need to do as well.
Okay. That was incredible. Last thing I'm going to ask you about, because we're basically
I gotta
out of
run
time here.
Yeah.
Last thing, man. I know where your position was in the past, like 3 or 4 times we talked, that there's no inflation. What's going to happen in 2022? Because the belief is when we start raising rates, either the Fed's going to have, like, they're not going to be able to raise rates enough and the market's going to crash, or we're going to keep inflating and then the market's going to crash. Like, the 2022 crash is coming. What's your take?
There's never been a time where inflation was bad for stocks. Stocks are a hedge against inflation. Okay, so when I was a little kid, that's what they taught us. Stocks are a hedge against inflation. If Target raises prices by 20%, their profits go up 20%. Okay, so the issue isn't inflation. The issue is supply chain issues that hurt margins. Okay, inflation is 100% related to energy at this point, and energy prices have already gone down. So supply chain and energy is already being alleviated. So I think when we look back a year from now, we'll still have inflation, but it'll be substantially less than today's level. But when you think about the markets for 22 and what the story is going to be, and obviously nobody knows the future, I think this Fed fear is going to be the non-event. The Fed is not going to do shit next year. That's my prediction. That between the coronavirus variants, all these structural issues in our economy, that for the Fed to raise interest rates when the long bond is only at 1.5 is a huge mistake. Because the long bond, the steepening of the yield curve, is what shows you have a strong economy. Okay? So the Fed knows this. And so if you've got 0 to 1.5, you and then the Fed raises rates, what will happen is you'll get a flat yield curve, and a flat yield curve means recession.
Yeah.
An inverted yield curve means 100% recession, 100% chance. So the Fed can't even do what they said they're going to do at the current time without basically causing a recession. Okay. Yeah. The market's already saying that. So the Fed doesn't need to think about it because the market's going to tell it what to do. And right now, the market's saying, you're not doing shit. And trust me, they're not going to do anything. Okay?
Do you think, the very last thing on this, do you think that Powell turned a little hawkish? Because my theory, you know, Jay Powell's seat's up for renom. Biden has a few tough talks with Powell. Hey, we're trying to get this Build Back Better plan done, but we need to assuage whatever Joe Manchin that we're gonna fight inflation. Can you get out there and just be a little bit more clear that you're gonna do the right thing about inflation? You're gonna make sure
that's not the way it works.
Okay, well, my theory, but I want to hear your response.
Well, you know, the Fed's an independent, you know.
Oh, come on, man.
No, I'll tell you why. Because
I know book-wise you're right.
No,
but it's
I'll tell you there's a
coincidence.
practical reason for this. There's a practical reason for this. Because when the Fed does raise interest rates, it isn't politically palatable.
Sure.
Okay? Because it means somebody's going to have to deal with the pain that comes with it, even though there's pleasure down the line. Politicians today don't want to deal with the short-term pain for what's best for this country. Long-term. Okay, that's why Powell isn't going to do anything. Okay, he's not going to do anything next year because we have an election year. So you think Biden and Powell are going to be like raising rates into an election year when they already got enough problems, and the Trump people are going to
Wait,
take
wait,
over.
wait.
You know, it's like,
you just said they're disconnected, but now they're
that's
saying
right. So by creating this appearance of disconnection, it allows them to operate right. But it allows,
okay, so it's a ruse. We're on the same page.
Sort of. They're independent institutions because it benefits both through plausible deniability through their actions. So the Fed can then act, and the president be like, "Look, this is what the Fed's doing," you know? And then the president could do shit, and the Fed says, "We have nothing to do with fiscal policy. Sorry, we're monetary policy." So fiscal and monetary policy are supposed to sort of work together, but they're also independent of each other, you know? And so like that appearance helps both of them to pretend that they're independent and to act independently in theory. But what Powell's trying to do right now, and the truth is, they don't know any more than we know about the future. And they need to keep the American economy going.
Yeah.
And the only way it'll keep going is with low rates. End of story. So if they raise rates, it's all over. And when they do start raising rates, third rate hike, I'm done with the market for a year.
Whoa, wait. You can't just drop a bomb like that at the end. What does that mean?
That's it. That's the bomb.
Are you retiring?
End. No, I said for a year. I'm not retiring. I'm going to sit in my bonds and cash and look for the greatest
bonds and cash?
Yeah. You got to do it for a year every 5 years, let's say. So 10 years go by. 2 years are bad. 8 years are good. The most important lesson, viewers, that I can ever tell you is don't play this game when you're just losing. Okay? You just step aside. You just step aside for a year, let the market do its thing, and wait.
Is this a shout out to Kathy?
Kathy's going to go double long right into the recession. You know what I mean? Hey,
all right.
Kathy's going to have to redo her
PE
ratios. Yeah.
Shout out your firm, man.
Yeah, Gerber Kawasaki. We're both financial advisors, and we have an ETF, GK, on the New York Stock Exchange. And you can contact us through GerberKawasaki.com if you need some financial advice. That's the most important thing. Yes, Kevin, financial advice, making sure your plan makes sense. Dude, I love the hair. Keep it that way.
You don't have this at your firm.
I know. Trust me, I was considering it on the way over, maybe trying to do something like this. But so that being said, contact us if you need some financial advice, tax planning. We have a tax and accounting. We do crypto now as well. You want advice on building a crypto portfolio. So basically, we're here to be a resource to help you build a better financial future for yourself. That's what we do at Gerber Kawasaki. No minimums. We only pick our clients by how great of a person you are. Thank you, Kevin, for having me on again. Love the show. Love the viewers. Always love our discussions. And I look forward to the next one.
Awesome. Link in the descriptions down below. Keep in mind, this was not paid or sponsored or compensated anyway. And just to remain impartial, I have not invested in GK, and I've got no money at your fund. It's not that I don't want to. I love you.
No, I know. Listen, it's fine. I don't take it personally.
All right. Well, stand by, Ross. Thank you so much, everybody watching. And if you enjoyed it, share it, and we'll see you in the next one. Thanks. Bye.